Good evening, and thanks to all who are on the call. I appreciate, today part of festive day, long weekend, and still all of you making it. Thanks for that, and best wishes of the season. Let me now, talk you through our performance for this quarter and half year. So before we get into the performance of the company, I'll just talk briefly about the environment in which we operated in this first half. It has changed significantly if you compare it to the last fiscal. As we entered the second quarter of this fiscal year, the macroeconomic environment turned adverse. We saw concerns arising from global trade wars, from Fed rate hikes, indeed from rising crude oil prices. All of this, of course, resulted or was accompanied by falling rupee, rising inflation, and then also we had the trigger of the NBFC liquidity issue, which adversely impacted flows into financial markets and performance of the equity markets in particular towards the end of the second quarter of this year. We've seen that FIs were net sellers in the first half with net outflow of over 28,000 crores, of course compensated by inflow from domestic institutional investors of over 570 billion rupees. Mutual funds assets under management of 22.1 trillion as on September 30th, 2018 went up 8% year-on-year from 20.4 trillion as on September 30th, 2017. Primary markets were also subdued. We actually saw a 68% decline in equity raised by Indian companies through various forms of ECM access. The number actually went down from 817 billion in the first half of last year to 259 billion in the first half of this financial year. When I now turn to company performance, I'll say that we continue to stay focused on our philosophy, even in these challenging times. And our philosophy is one of leveraging our technology edge, focusing on client acquisition, focusing on client activation, and diversifying our revenue streams even in these muted market conditions. So if I were to point out to some of the financial highlights for the half year, our company registered a growth in revenues for the first half of this year, with consolidated revenue growing by 4% year-on-year from 8,567 million rupees to 8,940 million rupees. And our profit after tax actually grew 8% year-on-year from 2,485 million rupees to 2,680 million rupees, despite muted market conditions. For the first half of this year, our company has registered revenue growth led primarily by our distribution revenues, which grew 18%. In spite of muted market conditions, our brokerage and related revenues grew 5%, and our corporate finance revenues declined by 17%, which I will point out is in spite of ECM activity being down 68% in the first half. The decline in corporate finance business was also on account of a high revenue base last fiscal, where we had actually managed some large deals for the first half of last year. We were also able to contain our costs. Our total cost was 4,837 million rupees in the first half of this year, a growth of 2% from 4,758 million in the first half of last year. With this, our cost-to-income ratio was 54% in the first half of this financial year as compared to 56% last year. Our return on equity is 59% annualized. Let me now turn to some of the business highlights briefly. We'll start with the broking business. In our broking business, our blended market share improved from 8.8% in the first half of the year last year to 8.9% this year, first half. The ADTO ex-proprietary was up 58% compared to market growth of 57% year-on-year. This was led by growth in average daily derivative volumes, which were up by 60% in line with market growth. The average daily equity volumes were up by 16% year-on-year compared to market growth of 11%. The company outperformed the market in terms of volumes in the equity segment. In line with our strategy to focus on client acquisition and activation, we were able to add 2.2 lakh new clients in the first half of FY19, and our active clients on NSE grew 22% from 6.9 lakh clients in the first half of last year to 8.4 lakh clients in the first half this year. Total brokerage revenue, excluding interest income, which contributed 53% of our revenues in the first half of FY19, increased marginally against same period last year from 4,751 million to 4,771 million, with retail forming 88% of total revenue. Brokerage revenue from retail clients stayed almost flat at 4,218 million rupees in the first half of this year compared to 4,230 million in H1 FY 2018. Interest income from our brokerage business has grown by 34% from 674 million in the first half 2018 to 904 million in first half 2019, primarily on account of growth in MTF book and margin funds deployed with exchanges. Brokerage revenue from institutional clients was 553 million in the first half of FY19, a growth of 6% from 521 million in the first half of 2018. Turning to the distribution business, revenue of our distribution business grew by 18% year-on-year from 2,069 million in first half 2018 to 2,440 million in first half 2019, and contribution and total revenues have increased to 27% in first half 2019 from 24% in first half 2018. We were the second largest non-bank mutual fund distributor by revenues in the country for fiscal 2018. Structurally, our AUM comprises majority contribution from equity, which has higher yields. Our mutual fund average AUM was 347 billion in first half FY19, a growth of 25% from 278 billion in first half 2018, compared to the market AUM average growth of 18% on a year-on-year basis. Our mutual fund revenue was 1,504 million in first half 2019, a growth of 23% from 1,225 in FY 2018. Further, our strategy of focusing on SIPs as a means of having sticky annuity income has resulted in a growing count of MS SIPs and stable inflows into SIPs compared to last year. There's a 35% year-on-year growth in SIPs triggered in the last month of the period from 0.5 million in first half 2018 to 0.7 million in first half 2019. On the regulatory front, SEBI has asked fund houses to follow all trail models to compensate their distributors and announced a significant reduction in total expense ratio charged by mutual funds. This would result in an adverse impact on the mutual fund revenues of the company. The implementation of the proposed change is subject to the Gazette notification. Our life insurance revenue was 210 million in the first half 2019, a growth of 18% from 178 million in the first half 2018. Turning to investment banking, our investment banking revenue was 606 million in the first half of this year, a decline of 17% from 729 million rupees in the first half of last year, as equity capital market activities declined significantly. Further, there was a base effect of handling 3 large equity and InvIT deals in the first half of last year. The company handled a number of investment banking transactions in the first half of this year, which included IPOs, InvITs, OFS, and advisory deals. Our focus on scaling up advisory business helped us in reducing the impact of decline in the equity capital markets. In summary, we have been able to perform well in spite of muted market conditions We are focused on scaling up nascent parts of our businesses and taking them to their full potential. We remain focused on our key strategic priorities, leveraging our strength in identifying and tapping significant opportunities facing our businesses. Thank you, and we are now open for any questions that you may have.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nilesh Shetty from Quantum Mutual Fund. Please go ahead.
Yeah, hi. The question is regarding the SEBI notification on completely moving to tail commissions. Could you tell us what is the mix right now of the mutual fund commission between upfront commissions and tail commissions in your revenue mix?
Yeah, so of course that's not something we've disclosed. However, I would like to say that as a house we have traditionally tried to actually focus substantially on trail. And because of that, of course, there will be an impact of, the SEBI circular, but we anticipate it will not be as high as, you might see it in some other players. Now, the extent to which, of course, it affects us, there are, in a sense, it is a bit work in progress because naturally you'll appreciate it's a discussion that is happening between mutual funds and distributors. But to my mind, while right now we don't have a number to put to it, right away, all I can say is as commissions go down, for us as a digital house, the opportunity is to use our digital footprint to keep expanding the market. So we are going to stay fully focused on that front.
So I'm just, it's sort of tough to gauge the impact of that whenever the the move is implemented. I'm just trying to gauge what is your sense of how much the number could change because of that.
Yeah, so, in a sense, one could do the math at a broad level for, the industry as a whole. All I'm trying to say is for someone like us who was not significantly, I would say, rather, let me put it differently, which had a significant focus more on trail than upfront income, I would say that, the impact on us will be less than, in general, the impact in the industry.
Okay, and sort of very large players have moved to a completely sort of advisory model and sort of charging customers and going completely direct. Is that something you have thought of in terms of as a business model?
Yeah, see, we certainly, Nilesh, look at all kinds of options, and I would say, not just because of, the pressure of, let's say, a SEBI regulation. We always look at these options from point of view of what is it that customers want, and these wants can be different for different people. So there are some, clients who would want advice, and with that to go direct. I mean, that's certainly, something which one would look at. There are, equally other customers who also want, a broader sense of research and advice and hand-holding from us. And for, those customers, we would actually have a different model. So, in short, all of this is very much, on the drawing table. To me, actually, the biggest thing is, frankly, the opportunity is large. We are a digital player, and, frankly, it's for us to really seize the opportunity, whichever way, one participates in the market.
Okay, and just a data point, because I think you've stopped reporting so what would be the life insurance premium in this quarter of the distribution income, or income from selling life insurance? Q1, I think it was about 87 million.
Yeah, so
in life insurance, we, at an overall premium level, we had a growth of 4%, H1 over H1. I mean, we have not put out the premium number, but as you said, so last year, what you're quoting is not the premium number. So you're talking about...
No, the income from distribution was about...
Yeah, so income from distribution is that we have already disclosed. So this was 210 million for H1 compared to 178 million as of last year. So this is a growth of 18% in the income.
Okay. Thank you so much.
Thank you. The next question is from the line of Tanubhav Vasisht from Sharekhan Limited. Please go ahead.
Yes, good evening. Thank you for taking my question. My question is pertaining to the blended yield. So we have observed that the blended yield has dropped consistently over the past...
Tanubhav, I'm sorry to interrupt. Your voice is breaking. If you're on speaker or hands-free, just take that.
I'm on speaker. I think I might be having network issues. Is it better now?
Not really.
Sorry, it's not very...
I'll wait in the queue. You can go to the next question then.
Okay. Sure. So until Tanubhav joins, we'll just move to the next question. The next question is from the line of Kishore Kumar from Unifi Capital. Please go ahead.
Yeah, thank you for the opportunity. Ma'am, I just want to get a sense of the entire year. How do you look at FY19 planning out? Because if you look at Q2, we see that the revenues were slightly higher at 5% on a quarter-on-quarter basis, and overall it's kind of flattish. But if you slice and dice and see September alone, how was the quarter on a monthly basis? How bad was September compared to last year's September? I'm just asking this to get a sense as to how the entire year will look like if the current market conditions were to kind of sustain.
Yeah, so, frankly, if you look at current market conditions, frankly, whether it is April or September, I think the fact remains that the sentiment has been, somewhat under pressure. It's just that probably in September we had a little bit more volatility. I think the first half, the market conditions and how we performed, I think that should, give you some sense, of, how we are responding to conditions such as these. I guess at this stage on the broking front, at least that's what I'd like to say. But if I, move on to the other part, which is, really the distribution part, I think the interesting thing over here is not just the contribution of our mutual fund, income and the growth in mutual fund AUM, but also as opportunity presented itself and clients had interest, we were, easily able to deliver through other market verticals. So illustratively, bond issues that happened, which we participated in, or, even, for example, the sovereign gold bond, which actually ended today. So these are, kind of different products which we are able to work with customers, even in times of muted equity conditions.
Right. Ma'am, and any comment in the slight decline in market share which we got to see on a Q1Q basis from 9.2, you have moved to 8.6. Would you like to comment on that?
Yeah, so, broadly, of course, from, quarter to quarter, there are changes that happen. I think in the big scheme of things, we would kind of look to stay around this range. I think that's the broad comment we would have.
Right. Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question, may please press star and 1 at this time. The next question is from the line of Rahul Sharma, individual investor. Please go ahead.
Good evening, ma'am. The one question which I have is, what's the size of your MTF book currently?
So we have not put down an exact number, but as we declared last time also, towards the end of the year, it was about 600 crores. So it ranges from about 500 to 600 crores in terms of the average book.
And what's the interest income on this book?
So our rack rate is about 18%, and we borrow at CP. The average could be slightly lower. The income for the first half that we have generated is about 40 crores.
Sorry, sir?
40 crores.
40 crores. Got it. Sir, based on the CP market, which is based on the liquidity conditions in the CP market currently, do we see pressure on being able to raise funds to be able to fund this margin funding book?
Not really. You'll appreciate ICICI Securities. We're a part of the ICICI group, first of all. Secondly, of course, there could be implications in terms of cost, but really, the way we operate is when there's an increase in cost, beyond a certain band, that's something which, we would pass on to our customers, as I'm sure the rest of the market also does. And in addition to that, we would also have bank clients which should support us at times, indeed, if there was pressure on the CP market.
Got it. Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. The next question is from the line of Tanubha Vasisht from Sharekhan Limited. Please go ahead.
Yes, good evening. Thank you for taking my question. My question is pertaining to the blended yield. So we've observed that over the years, the blended yield has dropped consistently. I believe it was around 1.1 at the end of FY18. So with the aggressive pricing model, adopted by the discount brokers, do we see further scope for the, blended yield going down? And do we have any plans to tackle that?
Yeah, so actually, unfortunately, the blended yield, the information it gives might not actually, in a sense, provide a holistic picture, because really it's to do with the product mix. So in any market where, let's say derivatives are higher, or let's say non-delivery volumes are higher, it would look like, the yields are under tremendous pressure. The fact of the matter is the market we've seen in the last 6 months, it is a market in which actually investors or, the delivery-taking customers have become a smaller proportion of the mix relative to the others. And therefore, broadly speaking, while our, equity yields would have kind of remained the same, broadly speaking, the mix is what has influenced the number that you are talking about.
All right. Thank you.
Thank you. The next question is from the line of Sneha Ganatra from Shubhkam Ventures. Please go ahead.
Ma'am, wanted to know on the first reason, on Q1Q basis of a market share has been declined, and this is because of the current market scenario. What is the outlook for the second half? How do you see your market share gaining? And any chance or to increase the new product lines or new products or something?
Yeah, so, you're right about the quarter-on-quarter. Like I said a bit earlier, broadly we are focused on staying, in the market share range that we have, which would be tending towards 9%, and that would be an area which, we would kind of look to maintain market share at that. From time to time, there are aberrations sometimes in the market which can influence one quarter and another. But broadly, we are, focused on retaining market share. Having said that, what I'd like to really point your attention to is if you look at our customer acquisition. If you, look at that, you'll see we're still continuing to grow our new customers. We've added 2.2 lakh new customers in the first half, taking our overall operational accounts to 4.2 million. That's the first thing. The second thing is if you look at our NSE active customers, which is a good, kind of objective way of looking at our active customers, that has shown a 22% growth. So the way we work is, even in conditions like this, when there is pressure in the market, we stay focused on customer acquisition, we stay focused on customer engagement. And with that, I'll turn to the second part of your question, which is, certainly we are looking at various different products which we will keep rolling out over the next few months to stay engaged with customers. And when I say stay engaged, obviously it means using our insights of what a customer wants to actually deliver the kind of products that we roll out. So that's something which we are fully focused on.
Okay. And my second question is on the cost to income. We are at trajectory of 56. During the IPO time, we're targeting around 55 to 54 range. So are we on track on that trajectory?
The first thing is we've not really guided on the cost to income ratio, but, certainly to keep that, at a good level and, to improve that is, always the objective. If you look at our revenues for first half, they've grown at 4%. If you look at our costs, they've grown at 2%. And with that, we've actually shown a 2 percentage point improvement in our cost to income ratio.
Okay, got it. Got it. Okay, thank you.
Thank you. The next question is from the line of Rohit Shimpi from SBI Mutual Fund. Please go ahead.
Yeah, hi ma'am. Hi Arvind. Thanks for taking the question. I just want to check within our, wealth management or, third-party distribution, do we have a significant chunk of, considering how the real estate sector has been under some stress, or at least perceived stress recently, is there a significant concentration of wealth management products being backed by, let's say, real estate entities or other structure? Thanks.
So significant, no. But, I think, in fact, in the last year, I would say we have actually not focused on this at all. So, in fact, in our asset allocation model, there was actually a very reduced kind of emphasis on these products. But I would say some historical, allocation would be there, but significant, no.
Okay. Do you perceive any, reputational things out of these kind of products, or any thoughts on that?
So it really depends on how, this has been approached with clients.
Sure.
So I would say that's really for every industry participant to kind of,
yes.
Look at. So it really will depend, case to case for different, models.
Okay. Thanks so much for this.
Thank you. The next question is from the line of Madhukar Ladha from HDFC Securities. Please go ahead.
Hi, good evening, everyone.
Madhukar, we cannot hear you.
Hello?
Yes, thank you.
Okay. Sorry about that. Good evening, everyone. Thank you for the opportunity. I wanted to get a sense of how much of the yield decline is as a result of pricing, and how much is it as a result of mix?
So,
Can we quantify that?
Yeah, so we're not going to be able to quantify it, but certainly it's largely on account of, mix.
Okay. Any sort of range, because largely...
So, Madhukar, structurally, as we had, been saying that the market overall, there is a mixed impact happening, and Shilpa did refer to what has been the trend on the blended yield, and what have been the main contributors, primarily driven by mix and the way the derivatives are seen, and whether that metric on a blended basis is that the way to look at it. So broadly, it is led by mix in a substantial manner rather than pricing. Our value proposition-led approach has always been there. So for us, it is mostly mix.
Okay. Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may please press star and 1 at this time. Anyone who wishes to ask a question may press star and 1. The next question is from the line of Rahul Sharma, an individual investor. Please go ahead.
Sir, can you help me with the exact life insurance premiums which have been sold by ICICI this quarter?
Yeah, so as I said, income we had already discussed earlier. In terms of the life insurance premium, I mentioned that we had registered a total growth of about 4% on total income. Here also, mix of the initial and renewal plays a part. On the premium basis, we have, because of the mix, you would see that the yields are slightly better off, because of which the income has grown at about 18%, whereas the premium growth has been about 4%. Not put out the premium numbers per se, Rahul, but this would give you a sense.
Got it. So, I mean, in Q1 FY19, the number was reversed, in which the life insurance premiums, the yields were compressed in FY18. So, what's the reason for the same?
Yes, actually at that time there were some regulatory changes as well. So that contributed, to compressing yields as well as degrowth in that business. I think once that's out of the way, we've actually gone back to the growth rates that we normally exhibit.
So is this a steady state yield on the life insurance product?
What happens, Rahul, in life insurance is that there will be an impact of the book, the renewal book versus the initial book. The rates could be different. Over a period of time, obviously, the mix changes slowly. So, over a longer period of time, it would kind of change gradually. But the bigger impact, what Shilpa just alluded to, that is now sitting in the base. And therefore, on a quarter-on-quarter, you would see that it would be similar.
Got it. Thanks.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. Anyone who wishes to ask a question may press star and 1. Participants, to ask a question, you may press star and 1. As there are no further questions, I now hand the conference over to the management for their closing comments.
Thank you, everybody, for joining us on this call. Good night.